Hello and welcome back, everyone. We are absolutely thrilled to be jumping into our next session. So, I'm Reda, head of content here at Finimize, and I have the absolute pleasure to be joined by Steven Tredget from Oakley Capital, where we are going to be discussing how to access the best private companies, but via publicly listed funds. Now, this session will run as a 15 to 20-minute fireside chat with our guest, followed by audience Q&A. So please feel free to submit your questions at any time using the Q&A box so we can bring your voices into the conversation. Stephen, it's an absolute pleasure to have you with us today, and welcome to the Modern Investor Summits.
Thank you, Reda. It's an absolute pleasure to be joining you.
Thank you very much. And we have, a really exciting topic to talk about today. But perhaps, the first question is really to kind of just set the scene for everybody. And basically, I would like you to give us a quick overview of private equity as an asset class and explain why it should play a key role in investors' portfolios.
Yeah, absolutely. I think the first thing to say is that private equity is a very broad description of an asset class, or it's a crude description of a very broad asset class, I should say. In that private equity encompasses venture capital, seed capital, money coming into startup companies, and it goes all the way through to large global mega cap private equity, if you like. And private equity managers themselves differ in terms of their specialisms. They can be generalist, invest across sectors, or choose a particular specialism, say healthcare or pharma or tech. And also they can be local, regional specialists, or they can be global. We're typically, when people typically refer to PE, they talk about buyout funds, and funds that are essentially taking controlling stakes, majority stakes in companies, with the chief benefit of that being that they can influence the outcomes of the companies they buy into. Why should we have exposure to PE? And I think there's a number of reasons, but one of the chief ones for me that was a very motivating factor for me when I joined the world of private equity was the sheer scale of the opportunity set. So 2/3 of global corporate revenue sits within privately owned businesses.
Wow.
So to not be thinking about how you get access to private equity is missing out on the largest, kind of subset of opportunities. And if you think private equity funds cherry pick, the best of those, and we'll go on to kind of why I think the kind of public market isn't attracting the best of those at the moment. And if you focus, kind of with a much European focus as Oakley Capital, it's even more heightened there. The penetration of, kind of public equity and private equity is even lower here. If you take companies with over 100 million of revenue, 100 million euros of revenue here in Europe, 96% of them are private.
Wow.
And as you can imagine, the majority of those are kind of founder-led. So there is a founder that's still in control of their own destiny. So the opportunity set is huge. Private equity are picking the kind of best of those. And if you just take the UK GDP, private equity-backed companies is probably making about 20% of the UK's GDP, just an example. So it's like, don't ignore it. It's a big chunk of, kind of your local economy that you're going to want to be participating in your global economy. And also there's the kind of, I guess the more relevant point is it has significantly outperformed as an asset class over time. And you can take an average of the last 25 years, you can take the last 5 years, whether it's versus PE versus FTSE All-Share versus the MSCI. If you just take a proxy of kind of a global PE index over the last 5 years, it's returned about 14% annually. MSCI 13%, FTSE All-Share 6%. There are other indices, if you look over 25, 30 years, where the disparity between those two is even greater. I mean, PE is probably outperformed by about 50% over that time. So it's kind of like, it's an area of the economy you don't want to ignore, and the managers that focus on it have outperformed as well. And then there's the fact, and I guess my kind of final point here is that private companies are now choosing private equity backing over the public markets. And there's two reasons for that. There's a greater value proposition that's being offered to them by private equity, that they're helping these businesses grow and develop and giving them the tools to do so. It's one less, more uncomplicated partnership than the one you're going to have with thousands of public equity investors, and it's kind of longer term in approach. If you take the public markets, you've got to give up your private information advantage. There is high costs of making that move. You're going to have to bring on C-suite to kind of cope with that. There's regulation, there's restrictions of M&A, restrictions of remuneration. The list kind of goes on and on. And as a result, the number of listed companies is declining rapidly. I mean, even in, if you just take the UK, the number of main list companies has dropped 25% in the last year or so. It's now down to about 950 stocks. That's not many you are getting to choose from in comparison to the private world.
That is really fascinating. So yeah, I guess a lot of investors who are ignoring private equity are really ignoring a huge subset of companies. I have a follow-up question on, one of the metrics he said, basically on that outperformance. And you're absolutely right. If you look at historical returns, private equity has outperformed, public equity, should I say. And in your opinion, how much of that is what, the so-called illiquidity premium, basically investors being compensated for taking illiquidity risk? Or is there something, fundamentally different about how private equity investors, do their investments that leads to higher returns?
I think if I had to choose one reason for doing it, it's the type of investing they're doing, or the type of companies they're investing in. So these are naturally, high growth companies in sectors that are, very exciting. They're often, new economy, tech-led businesses, disruptive businesses. And so it's the nature of the investing and the companies they're tapping into. If I look at some of the themes within Oakley's funds, there's AI, there's cyber protection and recovery, there's education technology, kind of really hot, high growing sectors where, frankly, there aren't too many opportunities like that yet within the public market. I mean, interestingly, certain sectors were big within private equity long before they became established within the public markets. Healthcare and pharma, for example, were backed by PE long before they became reasonably large constituents of the public markets.
Very interesting. And I guess, to a lot of people who are, listening to this, they hear private equity, and one of the first things they probably think in their heads, oh, a lot of leverage, a lot of debt. And maybe you can help us understand how the role of debt in private equity investing has changed in light of this new interest rate environment we're in right now. Interest rates are higher. Obviously, we're not, the past decade, they were almost zero, but that's not the case anymore. And how has that changed the private equity investing equation?
I think first of all, it depends on the type of PE investing you were doing as to the role that leverage played. So the larger the companies, and the lower organic growth that those kind of very big companies can achieve, financial engineering and the use of leverage was going to play a far bigger role in the creation of value within those businesses. And so consequently, as the cost of that debt went up, it meant that those larger global PE firms had to kind of look for growth elsewhere and come down the kind of size spectrum of companies to try to find more organic growth, because returns would have been eaten away by that use of higher leverage. So it had a much bigger impact in that element of the market. If I think about our realized returns, let's say our realized returns about 4 times money multiple, about 40% IRR. And if I look at the returns and how they're created, about half of those returns have been created as a result of organic EBITDA growth. 15%, let's say 20% of those returns would have been through M&A, acquiring businesses, enjoying synergies, kind of driving growth by going into kind of new verticals and geographies. Kind of a further 15% would have been through multiple expansion, i.e. you buy a business on 7 times and you sell it at 14 times thanks to the kind of growth and the quality of earnings you've introduced to the business. And finally, 10% was through the use of leverage. So it is a factor, but particularly in the small mid to mid-sized market, it's a much lower factor. And I mean, our general kind of, I guess if you wanted to make a general statement about PE, it has put greater emphasis, the higher interest rate, on organic growth and on value creation as the key skills that private equity managers have had to really kind of prove that they have, because they can't rely on leverage as a single kind of driver of returns. I would say in the main, I mean, the PE market is, still, I think the average global PE net debt to EBITDA multiples are still relatively high. They're still in that kind of 6 to 7 times, skewed by those bigger companies. If I looked at Oakley, our average is high 3 times, just below 4 times net debt to EBITDA. So we use it, but we tend to use it quite conservatively, and we use it rarely at the point at which we buy a business. We use it maybe to help them kind of grow through acquisition. We use it once we've improved the quality and the visibility of the earnings, and we use it in businesses where there's real visible growth. We may have introduced debt, it may be 4 times today, but it's going to halve that multiple due to the kind of growth of the EBITDA. These are companies whose EBITDA can be doubling year on year. I mean, the average growth is around about 15% EBITDA growth.
That's really fascinating stats, and I think you make it much clearer. So Steven, I'm listening to everything you're saying. I'm like, okay, private equity, huge subset that's being ignored, delivered better returns than public equity. Now I'm really interested. But let's say I'm a retail investor, because the reality is, right, historically private equity was reserved for big institutional investors, like pension funds, sovereign wealth funds, and so on. Obviously, you guys at Oakley are changing this through the publicly listed fund model, so OCI, or Oakley Capital Investments Fund. And do you view that as the primary way to democratize this asset class, or do you see other structures emerging for retail investors?
There are a number of ways to access private equity. I mean, to the punchline, I think for private investors like you or I, listed PE is by far the best way of doing so. I don't want to dismiss the other ways. You can invest direct into funds, but your minimum ticket size, you have to have a relationship with the manager. Your minimum ticket size has to be 5 to 10 million pounds, and you've got to be willing to tie that up. That's if you can get into the fund. You're willing to tie that up for the course of 10 years. Evergreens are, a vehicle that offers some liquidity on a kind of quarterly basis, but it's limited liquidity. And if the performance of the underlying manager declines and suddenly there's a kind of rush for the door, well, actually, that liquidity in practice will be very limited. If not, the fund, the evergreen will be gated. There are some platforms that allow you to invest into PE, but again, however you're doing it, if you're investing direct into a fund, 1, you don't know the constituents of that fund yet, it's not been invested, and 2, you're tying your capital up in those funds for 10 years. They will make, if you choose the right manager, great returns. Listed PE, you can see you're investing into the existing funds, 1, so you get to see what's in them currently. In our case, you get to see, a list of the 36 companies in which you're investing in. You have, I was going to say daily liquidity. You have minute by minute liquidity, so you can buy in and out of those shares kind of as you require. They've got all the benefits of the governance and regulation of being on the stock market, but you're getting direct access into PE funds. So, there is no kind of better way, I think, for kind of private investors to get access to that particular market.
Really interesting. And on the listed, private equity funds, you're absolutely right on the liquidity aspect. But I guess one thing, sometimes I hear from investors is that, look, quite often these funds trade at a discount to their NAV, their net asset value. And for an investor, watching this, how should they interpret this discount? Is it a warning sign from the market, or perhaps it's an opportunity to buy, high quality assets on the cheap? on a discount?
Yeah, I think the first thing I say around the discount, I understand why it's focused upon, because it's one of the few metrics you can look to kind of take a view as to whether or not a share is kind of in an investment company is trading at its net asset value, which we report on a quarterly basis, above it or below it. It's a kind of an instant sense of, is this a well-liked, well-rated, is there an opportunity to get in cheap, is it expensive? But in reality, discounts are kind of pervasive across the investment company universe. I mean, here in the UK, there's 300 odd investment companies. They make up a big constituent of FTSE 250, and they trade at an average 50% discount. And why? Because, you know, there's fears around the underlying asset liquidity. If you had to fire sell your assets, what discount would you take to do that? In many cases, it's quite opaque. It's quite hard to value the underlying companies. And so there's a natural kind of concern, unlike a single listed operating company where you can really delve into the accounts of that particular company. You don't have that luxury, particularly in listed PE. And also, I don't think private equity is particularly well understood, just generally as an asset class, along with the kind of costs associated with it. However, the reason I think it's a red herring is that if you take OCI, Oakley Capital Investments, the listed PE company that invests in the funds managed by Oakley, it is one of the best performing of all investment companies, particularly of the listed PE funds, over the last 5 and 10 years. Throughout that time, it has had a persistent and relatively high discount. What matters most when you choose vehicles like this is you're taking a bet on the manager being able to grow its assets and on that net asset value per share growing over time. And that's exactly what has happened with OCI, such that you'd have made 130% over the last 5 years, 300 and whatever it is, 60, 70% over the last 10 years, regardless of discount. Now, if the discount closes, well, that's a kicker on performance. And there are lots of kind of indications as to why that discount should close. I mean, the best thing I can kind of say to you in terms of why I believe the discount shouldn't be pervasive and why I think it will close is just how we've demonstrated, you know, when we've sold assets, we've sold them at least at NAV, on average, at a 35% premium to the book value. And in the case of VLEX last year, which is an AI-powered legal data platform, we sold it at a 300% premium to the value that we're holding at our books. Generally speaking, private equity applies, you know, kind of pretty conservative valuations to their underlying portfolio companies. And the reason is we have very little incentive to pump them up prematurely. We only get a performance fee at the point in which we realize a company, when we exit it. So in the meantime, last thing we want to do is have to mark a company value down if we can avoid it. We're going to take a view on the company when we first buy it. We're going to, you know, take months to do due diligence. May spend millions of pounds in the process of doing that to find a company and to accurately value it. We're rarely going to then change that value in our books, you know, for at least, you know, a year or two after that, and only then because the company's grown in size. And only when we typically hold a business for 4 years will we, at the end of that period, think about, okay, what realistically now do we think we can sell that business for in the market based upon the kind of comps around it. So often there's a lot of white space between where the private, particularly for Oakley, where the companies are being held out on our books versus where you might be able to sell them if that was the point you'd reached.
Really, really interesting. And on that point, you mentioned that, you know, should the discount narrow or disappear, obviously there's like a nice kicker. And I'm really curious, does Oakley take any measures to basically try to keep, you know, OCI's price close to its NAV?
When Oakley's single job is to make returns. So its job is to manage the funds it manages. It manages about 16 billion euros, of which OCI is one of the investors in those funds. And so our job is to focus on those tech companies, education businesses, consumer digital businesses, business services that we kind of focus on. Great companies like IU Group, which is an online degree business based in Germany, where we've seen the student numbers grow from 15,000 to 150,000 over the 5 years that we've owned it. OCI has a board, and the board kind of focus on that discount point. Now, there's two things that we can do. I mean, on one side of things, we've got to keep performing. And if we perform and we give people greater confidence in the kind of current NAV and the future NAV growth, then we'll attract more people to this asset class. The second point is transparency. The more we can reveal about, the kind of portfolio, the more we talk to people, the more we draw people into this asset class. So communication and transparency is another kind of area that we focus on, kind of bringing more demand to the sector. In the meantime, there are forces that are working that I think are going to start working towards us. Supply is coming out of the market. There's something called secondary funds. These are funds that buy existing stakes in PE funds. And that market has really grown in size, because of the popularity of private equity, and because if buying a secondary stake a few years into the life of a fund, you kind of get further along the J curve, which is attractive to investors. It's secondary funds now are coming to and buying listed PE investment companies because they're trading at a discount and they can buy those secondary stakes. And that's happened recently with the announcement of Apax's listed vehicle being taken private. So supply is coming out as a result of that and buybacks. And in the meantime, more people are kind of waking up to the listed private equity opportunity, and steadily demand is also starting to kind of increase.
Very, very fascinating. And actually, maybe that's a good leeway to some audience Q&A, because I actually already have one question up top over here touching on secondary. So the question is, with the increase in secondaries, where are we seeing the freed up liquidity getting allocated towards? Also, where do you see M&A volume by the end of 2026?
I mean, we're seeing, I guess I'm kind of, pointing to where that secondary liquidity is going. Money, as is the way in the global economy, money finds returns, and it seeks mispricing, and it's finding its way to the public market. And you've seen that with the de-equitization of the public markets, with private equity taking private a number of companies, and it's now happening within listed PE, with the secondary markets coming to buy mispriced positions in PE funds. So kind of deal with that point of the question. And then M&A volumes. I mean, generally speaking, it's been a more muted market for exits. And I think one of the kind of chief reasons for that, we've still got liquidity, as in debt liquidity. So the wheels of the market are still turning. There's still plenty of dry powder within PE funds. There isn't an IPO market, which is in some ways leading to a little bit of congestion within PE, particularly the bigger PE funds who are clearly holding on to companies a little bit longer. But the thing that in any market you need is stability. You need certainty around kind of politics, global economies, so that you can take a view on the kind of prospects of a company, the right pricing for that company. And over the last couple of years, I guess from COVID onwards, there's been such shocks in the market, it's very hard for buyers and sellers to find, kind of alignment on certainty and price. I would suggest this year, and particularly in the second half of the year, you're seeing less kind of volatility in valuations. You're seeing a greater certainty coming into the market, and I think you're seeing deal flow increase. So I'm cautiously optimistic that the direction of travel has improved, kind of year on year, from a low in 23, starting to see a little bit more signs of life in 24. This year, again, has picked up slightly. Again, it depends in which region you're talking, what size of company. The good thing for us from an opportunity perspective and this is for Oakley, is that without the public markets and with a high cost of debt, PE and buyout funds are one of the few functioning investors in this particular market right now. And as a result, we are seeing way more opportunities than we've kind of seen historically. We're very focused. We might make 6 to 8 investments a year in very specific disruptive businesses, SaaS software businesses or schools businesses or kind of digital platforms. We looked at a total hopper of 4,000 opportunities in the last year. So the one thing that the current market is presenting us with is a lot of opportunities. There's dislocation in the market as there is now. And you've got founders that are really looking for support, either that's financial support or they're looking for help with M&A, digitizing their businesses, growing outside their region, then which the current environment is presenting them with that opportunity, then it's really kind of playing into the hands of private equity managers.
Really, really fascinating. And this is probably 2-3 different questions all along the same line. So I'll just condense it into one, which is basically, we find a lot of retail investors are aware of private equity as an asset class, but they just don't invest in it. And people are curious to hear your thoughts. Is that a matter of risk aversion? Is that a matter of accessibility or some other matters? And what can be done to address that?
Look, it's not a particularly particularly here in Europe. I mean, when we speak to investors in the US, I think there's a very different mindset to private equity there. It's been around for longer. There is a different culture mentality towards founder businesses and founder success. It's a point of pride in the US. The market is mature as a result. I think speaking to some of the big investors on the West Coast, they would say that they feel that Europe's about 10 years behind in terms of the kind of public perception of it, the desire to be exposed to it. And we're starting to kind of see that increase. So I think we're going to see a change, particularly here in Europe, in the media perception of private equity, which I think has been slow to shift. I think we're getting more sophisticated in our ability to kind of tell the story and help people understand how to value the business. And I think most importantly, I can understand the cynicism of PE when you had a zero cost of debt, you had a strong background economy, and all these PE funds were kind of making, hay while the sun shines. And, there was a lot of talk about just how wealthy they were getting in the process. And I can see that kind of generates a bit of cynicism and also a sense that, well, what happens when times change? Now, we've seen a changing time. We've seen a higher cost of debt. And we've seen a kind of a more muted macro environment. And what's been really encouraging, particularly from, kind of for OCI and for the listed peer group, is they've carried on growing over that time. Yes, we haven't grown now, NAV at, kind of 25-30%, but we've still been growing at double digits. We've still been generating, kind of high shareholder returns. And I think that's helping to kind of grow that confidence in this particular space. And so we're certainly seeing it in our share register. I mean, we pre-COVID had 3% of our register was owned by retail investors. If I just took the 3 main retail platforms here in London, here in the UK, they account for about 15-16% of our register now. And so, we've got evidence of that, that mentality and the approach to PE is starting to shift amongst private investors.
Really fascinating. And I think we have time for one final quick question. And we have one user basically asking, how do you see private equity gaining ground into less financially mature and capital thirsty smaller markets, such as smaller European economies?
Sorry, Redis. Say that again. So how's it gaining ground in less developed?
So do you see private equity and private equity investors, basically growing and entering these, smaller, less mature, less developed European economies and investing there?
Yeah, absolutely. I mean, there's private equity is a global industry, and there's been kind of, entering into, the majority of Europe will see a kind of thriving private equity investment community. I mean, I think from our perspective, there's still relatively low private equity penetration in some quite developed, large European economies. I mean, if I take, for example, our recent successes in Southern Europe as a great example. I mean, there's an incredible opportunity set in Spain, Italy, Portugal, for a variety of reasons. One, you've got a great entrepreneurial heritage there. You've got under-penetration from PE in the public markets. You've also a gateway into the Spanish-speaking world as well. And we've been able to kind of invest in businesses. I mentioned VLEX earlier, the legal data platform. We have a logistics business, Alerce, based in Spain. We have Horizons, an optical solutions business that's based in the area. And we've had the opportunity to build leading software players where there isn't already a mature market. So we've been able to go into these markets and through M&A create leading independent, in one case, business service software player in Grupo Primavera that we've then sold on to the larger PE players who are consolidating that space globally. That's out of our kind of remit and ability, but we've sold that on to Sajid. And that's typically what we're doing. We are the first time backers of companies. So in 90% of cases, we're dealing with founders who have never taken private capital before. They're very anxious about that. They want a partner that's equitable, empathizes with them, is genuinely going to be additive to their growth story. And then we're going to hold for 4 or 5 years and then sell to the larger global PE players. We've got deeper pockets, can take these businesses on a global journey, which is kind of fine by us. That's, we're very happy with where we sit in the ecosystem.
Amazing. Thank you so much, Steven. I honestly really, really enjoyed that chat, and I definitely learned a lot. So on behalf of myself and the entire community, thank you so much for sharing all your insights.
Thank you very much, Reda. I really appreciated it.
And thank you, everyone, for your thoughtful questions and active participations. That brings this session to an end, but please stay tuned. We'll be back shortly with more great conversations. See you soon. And Steven, thank you very much once again.